Hey, so good morning, all. My name is HANSPAL, and we can begin with the session for today. So, in the previous session, we talked about the liquidity ratios. And like when we were talking about the liquidity ratios, we tried to discuss about the current ratio, and we tried to talk about the quick ratio and the cash ratio. And we tried to bifurcate between all these three ratios. So, that was the major agenda of the previous session that we tried to talk about. And when we were talking about all these three ratios, the major supremacy that we gave was towards the cash ratio. Because cash ratio was something which took into consideration just the cash, whereas the current ratio and the quick ratio were taking into consideration the other current assets as well, be it the debtors, be it the prepaid expenses, be it the inventories, and so on, which might not be useful when certain kind of liability has to be paid off immediately. So that we try to discuss. And even in the cash ratio, we try to talk about the modified cash ratio. So what was the modified cash ratio? The modified cash ratio was something in which in the numerator part, we were not using the cash equivalents. Just the cash was being taken into consideration and only the current liabilities in the numerator. Okay. I've also published a blog upon this fact. Like if people can refer that blog on LinkedIn, and I've shared the same on the group as well. Okay. So in this session, as the title suggests, a talk on debt. Okay, so that is quite clear that we're gonna talk about some of the debt ratios. Okay, and like we're gonna talk about from a different perspective in the same way as we talked about the liquidity ratios. And in the subsequent sessions, like we're gonna talk about the other ratios as well from a different perspective. Okay, from the analyst perspective, like for example, if you're going for a role of an equity research analyst or core investment banking, so you need to develop a different mindset about these ratios because what we learn in the books or like what we learn on Google is something that is like really great. But to understand these ratios or to imply or to like use these ratios in the practical way, that sometimes tends to be different. So we need to understand it from a different perspective because there are like thousands and 2,500 companies being there in the stock exchanges. And in the practical world, the people might have to deal with these 2.5K companies. Okay. In the hypothetical scenarios, either we tend to deal with the companies that does not exist, the hypothetical companies, or we tend to just deal with like one or two companies for comparison. But in the real life scenario, as an equity research analyst job or a core investment banking job, you might have to deal with more than 2.5K companies. So in that case, you need to understand a different perspective of these ratios, and that we'll try to understand in the continuous sessions as we go ahead. So I will just share my screen to you and we'll begin with the debt ratio. And like, just let me know if my screen is visible to all. Just put a yes or no in the chat box if my screen is visible to all. Okay. Yes, 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 yes. Okay, fine, fine. Thanks, Mesh, Raghav, Sunanya. Okay. So basically, in the first ratio, as we all know, the most popular ratio is the debt to equity ratio. Okay. Give me a second. Yeah. The most popular ratio is your debt to equity ratio. Okay, and the most of us who are the students of finance and maybe not the students of finance, I've given a fair bit of understanding in my modules for the debt to equity ratio. Okay, and if not, let's try to understand the debt to equity ratio from the very scratch because the basic purpose of this curriculum is focus less upon the modules and focus more towards the life practical session because all those things like which might have been taught in the modules are covered in the same way and in a far better way in these practical live sessions. Because like before we start learning the financial modeling of the company, we need to understand these ratios and the financial models and the valuation models. And after that only we can understand the financial modeling. Okay. So the debt to equity ratio, as the name clearly suggests, we have the debt of the company in the numerator and the equity in the denominator. So the first question that tends to come in the mind of the people is, what does this ratio tell us? This ratio basically tells us out of the total financial structure or the capital structure of the enterprise, how much equity the company is using and how much debt the company is using. A very simple example. Like for example, if I am running a heavy industry, like for example, a metal mining industry. Okay, so I am the owner of Tata Steel, like just for example. So if I want to expand my manufacturing activities, if I want to diversify my business, correct? Either way, I need some money for that. So two ways to raise money. The one way can be to raise debt. Now, the debt can be raised through either through banks or through public, right? How through banks? Like we can go to the bank and say that we want to expand our business, we want to diversify our business and give us debt of like 5 crores, 10 crores, or like 100 crores. And the bank will give that because the bank knows that the business is profitable and the business is doing good. Okay. So ultimately, high ticket size of loans can be given to such companies. The second way to raise debt can be through what? The first way was through banks, and the second way was through your bonds. And we all know that what are bonds? Bonds are your fixed income instruments that the issuer will raise, or the issuer will put these bonds or contracts in the market to raise some money, right? Like for example, if I am the owner of Tata Steel, I issue bonds worth rupees 1,000 crores. Like for example, if my requirement is 1,000 crores, my company Tata Steel will issue bonds worth rupees 1,000 crores, and I will guarantee the general public that I will pay them a certain rate of interest as per the market dynamics. If the interest rate is too low in the market environment or the global scenario, I might be giving a too low interest rate. If the interest rate is high or my company is risky, then I would be giving a higher rate of interest because riskiness also matters in this scenario. If my company is really good, if my company is earning huge profitability, if my company has huge cash flows, good future projection, good profitability ratios, good valuation ratios, good interest coverage ratios, and different amount of ratios, in that case, my company tends to be considered as a less risky company. Okay. In that scenario, I might be giving a lesser interest rate because the major rule of market, higher the risk, higher is the expected return, and vice versa. Lower the risk, lower is the expected return. Similarly, in this scenario, when my company is really good up to the mark, there is lesser risk for the people who are purchasing the bonds of my company. And as a result, I would be giving them a lesser rate of interest. And the second example, if my company is too risky, my company has negative cash flows or zero cash flows, my company is into losses, my company has huge debt, like we can try to compare the scenario with the Adani enterprises. In that case, the company is very risky. The company has to pay a higher rate of interest, and that is also a way to induce people to get into those bonds. Those bonds can default also, right? The risky bonds can default also because they might get a rating of like C grade or B minus grade or D grade of junk bonds. Okay, so that is the negativity for that bonds or the disadvantage to purchase those bonds because those bonds are the risky bonds of C grade, of B minus grading, of D grading, right? Those are the risky bonds, right? So that is a disadvantage because those bonds can go bankrupt also. It might happen that the company goes bankrupt and the company is not able to pay you back. But the major advantage of those bonds is since those bonds belong to a risky company, the company would be paying you a higher interest rate in that scenario, right? A higher interest rate, and that is the advantage. So bond giving a higher interest rate can have both advantage and a disadvantage. Similarly, for a company which is a good company, a company that might be giving you a lower interest rate, the basic advantage of that non-risky bond is your bond is secured, right? Because the company won't go into bankruptcy. And the biggest disadvantage is that you are getting a lesser interest rate, which might not even beat inflation. Okay. So having a bond, a risky bond or a non-risky bond, both has its own advantages and disadvantages. Also, like one thing needs to be taken into consideration is a good bond, a less risky bond, a A-grade bond, the best bond like which I'm talking about can also default in 1% or 0.1% of the scenarios. Similarly, a bond which is the most risky bond, सबसे घटिया bond, बेकार bond, it can also happen that such bond do not default and pays you money. Okay, so these things also have to be taken into consideration because you have your credit rating agencies. For example, you have CRISIL, your Credit Rating Information Service of India Limited. You have your ICRA, Investment Credit and Research Information of India. You have CARE, your Credit Analysis and Research in India. Like these three companies, your CRISIL, your ICRA, your CARE, and globally you have your Moody, you have Standard and or S&P index. All these rating agencies tend to rate these companies. The question is, who rates these agencies? So like that is a matter of different discussion. But the thing is, they tend to rate these bonds. And a fair understanding, if I give you A plus or A plus plus, A1 is something which is your prime bonds, the best bonds that the name suggests. Up to your A minus or simply A to B plus, these are your investment grade bonds in which you can think to invest. Then you have your B minus and to C. These are your speculative bonds. Speculative bonds. And the last one is your D, your junk bonds. Sabse ghatiya category. Junk bonds. Okay, so like certain companies might have prime bonds as A plus plus plus. Some companies might say prime bonds as A1, right? So this A1 or A plus plus can differ from different companies as per their papers or as per their the way they portray the ratings. But the major understanding is your A plus plus category or the A1 category is the prime bonds, the best bonds that will give you the lowest interest rate. Or something from A or A minus to B plus are your investment grade bonds, which might give you a bit higher interest rate than prime bonds, but the difference might not be so much. Then from B minus to C, you have a speculative bond that might give you a fair higher interest rate, because from that particular point of time, the risk starts to increase. And after that, you have the grittier category of bonds, the junk bonds, which might default, but will give you the higher interest rate. So these ratings you might have to see. Okay. Now I'll just remove this and coming back to the topic. Right. So debt we understand, like how can the company raise debt? And the second way the company can raise money from the market is through equity. The company can float shares in the market. People would be buying shares in the market, and that money would come to public, either in the form of IPOs. It can be your IPOs, initial public offering, that we all know when the company comes up in the market and lists itself on the stock exchanges for the first time, or through FPO, which is a follow-up public offer, where the company comes up for the second time to raise money. And one more thing, in an IPO, the company comes for the first time to raise money in the market. Then FPO, a follow-up public offer, the company is already listed in the bourses or the stock exchanges and come for the second time to raise money. But in these IPOs or FPOs, first time the money goes to the company only. And in the second time, it gets exchanged between the investors who are buying and selling the shares. In an IPO, in an FPO, for the first time, the money goes to the company only. Okay. So the company can raise money through debt or through equity. Okay. So like that, we got to know. So in debt, we need to understand whether we have to take into consideration short-term debt or long-term debt. In schools and colleges, our faculty says us to take just the long-term debt. No. Ideally, in a scenario, you have to take both the short-term liabilities and the long-term liabilities. Both have to be taken into consideration. Just assume if you're just taking into consideration the long-term liabilities, right? In that case, what will happen? In that case, it can happen that the numerator of the equation tends to be less and the denominator of the equation tends to be more. Because one thing we need to understand, we tend to prefer a company having a lower debt to equity ratio. What people say, prefer a company always having a lower debt to equity ratio. Always word pe dhyan dena. Prefer a company having a debt to equity ratio as low as possible always. Though that's not always true, we'll talk about that. But ideally, people tend to say that prefer a company having a lower debt to equity ratio. And when will this debt to equity ratio be lower? This debt to equity ratio will be lower when your equity is more, when your denominator is more, correct? And your numerator is less. In that case, your debt to equity ratio will be low, correct? So in the scenario, when only the long-term liabilities have been taken into consideration, it can happen that the ratio appears to be too low because the short-term liabilities have not been taken into consideration, correct? Because in that way, fair value of the total debt we have not accounted in the numerator. Thus, long-term liabilities we have accounted in the numerator, and equity is just the same, correct? So we need to take into consideration both the short-term liabilities and the long-term liabilities. So that is something we got to know. And apart from that, now let's come to the point. People tend to say a ratio of less than 1 is preferable when the equity is more than debt, or a ratio closer to 0 is like preferable, because that states that the equity of the company is more, right? and the liabilities, that is your short-term liabilities and long-term liabilities is less. Okay, understood. Now let's try to understand the background of this thing. That is just a bookish knowledge that like prefer a company having a lower debt to equity ratio. Okay. Now let's try to understand the advantages and the disadvantages of a higher debt to equity ratio in different situations and the advantages and the disadvantages of a lower debt to equity ratio by taking into consideration the different scenarios, right? So the first scenario, having a having a higher debt to equity ratio. Okay. So what do we mean by having a higher debt to equity ratio? A higher debt to equity ratio is something when the equity of the company is less and the debt of the company is more, a risky situation, right? Is that always good? No. Is that always bad? No. A company even having a higher debt to equity ratio can be good for the company. You might be hearing this for the first time, or like you might have heard from different analysts on the market also. I don't know about that. But a company जिसके पास debt ज़्यादा है and equity कम है, a company having a higher debt and lesser equity can also be a good status for the company. Why? If the profitability is rising continuously, if the cash flows of the companies are rising continuously, right? In that case, we can say that even having a higher debt to equity ratio is good for the company. The first point, the profitability is rising, the cash flows is rising. In that case, we can say the higher debt to equity ratio is also good for the company. Second case, not only the profitability rising and cash flow rising, the profitability and most importantly, the cash flows, because I have been stressing upon the point of cash flows from day one, is rising at a higher rate than in the increase in debt. If the debt is stable, just assume the debt to equity ratio is high, but the amount of debt is stable. The company is not raising some additional debt, and the cash flow is rising. It is best for the company. But in the scenario, if the debt is also rising, like in case of Adani's or some other companies, if the debt, I'm not like preferring Adani's here. I'm not like no, the stock recommending Adani's here. In case of Adani's, the debt is rising, but the cash flows is rising, but not by a higher proportion than debt, or not by a same proportion of debt. Okay, so that is wrong for that company. Might be wrong for that company because I cannot like recommend stocks. But the thing is, if the debt of the company is rising, now I'm taking a general scenario. If the debt of the company is rising, but the cash flow is rising by a lower proportion, if the debt rises by 50% every year, but cash flow rises just by 20% every year, higher debt to equity ratio is not good. Company बर्बाद है, छोड़ दो. But if the debt of the company is rising by 50% and the cash flows are rising by 60%, even by 50.5%, 51%, 80%, 100%, in that case, go for that company because the cash flow of that company is rising more by debt. The company will be able to pay off debt. And this concept we tend to call as your beautiful leveraging. Beautiful leveraging. When the debt is rising and the cash flow is rising by more than debt, or beautiful deleveraging. There is a difference between beautiful leveraging and beautiful deleveraging. Okay, but both are considered in the positive scenarios. Your beautiful leveraging is something when the debt is rising by 50% per se and the cash flows are rising by 55%. That's like beautiful leveraging. And your beautiful deleveraging is the scenario. The debt is constant, but the cash flows are rising by the higher rate, right? Or even if the debt is rising, you are like paying off the debt, like with those higher cash flows. That paying off factor is there in the beautiful deleveraging. Because deleveraging is something when the leverage is reducing, you are paying the interest. And beautiful leveraging is something the debt is rising, but the cash flows are also rising by a higher amount. That concept of paying is not there. Okay. So like this, we need to understand. And the third reason can be those expansions and diversifications which the company has done are for good reasons. Like for example, if Infosys, which is an IT company, comes to the news and says that we are starting some metal mining operations, or we are like starting with some housing building operations. In that case, those diversification and expansion opportunities won't be considered good because it's an IT company. People have faith into that company as an IT company. They cannot trust Infosys for some housing building projects or some metal mining projects because already this industry is so saturated and all the other companies are making billions and billions dollars of expansion efforts into this, right? So in that case, it won't be considered a good decision. So having a higher debt to equity ratio can be considered bad for that company. But if the company goes into some goes into some digital technologies, some newish technologies, and the money is going towards that, and the company has taken debt, in that case, we can say having a higher debt to equity ratio can be good. Okay. So like these three scenarios we need to take into consideration. So that is the most important thing. Any more queries like this, let me know in the chat box. Like any more queries you have on this. Then we can proceed further if no queries. Okay. So like one thing also like you need to take into consideration till what point the company can raise more debt. I'm saying till what point the company can raise more debt. The company can raise more debt till the time when your cost of equity is greater than your cost of debt. Cost of equity is something, the return that you have to provide to the equity shareholders, expected return, and the cost of debt is something, the interest rate that you are giving on your bonds. Right? So till the point of time when your cost of equity is more than cost of debt, increasing more and more debt will have a magnifying effect upon the EPS of the firm. I will repeat this point and this you can also answer in your interview as well. Till the point of time your cost of equity is greater than cost of debt and the firm is taking more debt, it will have a magnifying effect upon the EPS of the firm. Firm's EPS will rise, firm's earnings per share will rise, firm's growth prospects will rise, firm's profitability would rise. But if your cost of equity starts to come down and becomes lesser than cost of debt or even becomes almost equal to cost of debt, you must not take more debt. Your EPS will come down, your earnings will go down, your profitability will go down. So I'll repeat this point. At the point of time when your cost of equity is greater than cost of debt, you can afford to take more debt because it will have a magnifying effect upon the EPS of the firm. Good condition. But at a point of time when the cost of equity becomes less than cost of debt, the EPS of the company can fall. So do not take debt in that scenario. Correct? So that thing you need to understand. So that was the scenario of having a higher debt to equity ratio. So a company, if having a higher debt to equity ratio, can also be good for those companies if all those four parameters are justified. Rising cash flows and profitabilities, rising cash flows and profitability by a higher rate than debt, correct? Then the third one was the companies into like good diversification, expansion opportunities, and the fourth point is cost of equity is greater than cost of debt. Okay. Then the second scenario in which your debt to equity ratio is less. It means it's a good scenario because the company is having lesser debt, right? So obviously everyone would prefer that scenario when your debt to equity ratio is less or closer to zero. So that's a good scenario because the company has lesser debt, the company won't go into bankruptcy costs and all those stuff. But that can also be a disadvantage for that company. Why? It can happen, the market might assume that the company is not taking more leverage because I told you a point that till the point of time when the cost of equity is more than cost of debt, the firm will have a magnifying effect upon the EPS of the firm. It can happen that the market might assume that the company is like not going for some expansion opportunities, for some diversification opportunities. The company is set to go off from the market. ठीक है, like company अपने आप को बंद करने वाली है. The company is not going for some further future projects, and that is the reason the company is not raising debt. If the company is raising equity for that, right? So in this scenario, when the company is not raising equity, or neither the company is raising debt, it can be considered the company has no future prospects. Still, the share price of the company can go down because people might assume that the company is raising neither debt nor equity. The company has no good future projections. But in the second scenario, the company has been raising equity and no debt. That can be considered positive still, but it will dilute the value of the existing shareholders. Like for example, what's the formula for the EPS of the company? It's your profit after tax, but the number of shares outstanding, correct? And like what do we mean by the number of shares outstanding? The number of shares like which are being bought and sold in the market, the free float shares. Okay. So if the EPS of the share had been like just assume if the PAT was like 200 rupees and outstanding shares were 10. Okay, so what was the EPS? 20, a good EPS for the company. But if the company is raising money through equity and no debt, the outstanding shares will increase. Just assume the profitability same PAT and the outstanding shares like they get increased to like something around 15, right? The outstanding shares get raised to like 15 because like more equity has been raised in the market. So won't the EPS of the company come down? Of course, the EPS of the company will come down. It will be nothing but your 200 by 15, 13.3 approximately. So now the EPS of the company has come down. And EPS is one of the most important indicators that we tend to see the growth of the enterprise. You'll see EPS to pehle 20 tha, and now the EPS has come down to 13.3. The growth prospects have hurt. Even the person who might be holding like 20% shares in that enterprise, his holding might come down. By how much? If a person is holding like 20% shares in the enterprise, his holding might come down to the extent of 1 minus additional 5%. Correct? Because agar shares 20 the or 10 the, now the shares have risen by like 15. Approximate number I'm taking, like just for the sake of simplicity of the calculations. Right? So even if we do, so when we take into consideration, his holding might also come down, right? Because like more new shares are being like taken up in the market, more new shares are being get floated into the market. Okay, so this can affect the value of the equity shareholders. The equity shareholders might not be happy, right? When like more debt is being raised, the debt holders are not happy because that tends to increase the riskiness of the firm, right? In both the scenarios, see, be it just a second, be it when your equity shares are rising, okay, like just the scenario when your equity shares are rising or the firm is issuing more shares, the equity shareholders are not happy because their value is coming down. Even when like more and more debt is being raised, the debt holders are not happy, right? Why? Because even the because the risk for those debt holders is increasing because the company is taking more and more debt, the company is issuing more and more debt. So the cost of debt will also rise. So in both the scenarios, both the equity holders and the debt holders are not happy. Raising more equity, the equity shareholders are not happy because their value is coming down. Raising more debt, the debt holders are not happy because the risk of the firm is increasing. So at least we need to strike a balance between the two, which is really very difficult. Correct? So when the firm is raising more and more debt, the cost of equity will rise because ultimately the cost of debt will rise, sorry, because the interest rate is rising and the firm is tend to becoming more risky because the firm is issuing or taking more and more debt, right? And when the firm is taking like more and more equity, even the cost of equity will also rise because the value of the equity is coming down and even the shareholders are feeling like more risky, right? But tell me one thing, if your cost of debt is rising and the riskiness of the firm is rising, will only the cost of debt rise? Tell me one thing. Just leave everything per scenario. Leave everything out of your mind. If the cost of debt is rising, the riskiness of the firm is rising, will only cost of debt rise? And that we learn in books, that only the cost of debt is affected. No. In the practical scenario, cost of equity is also affected because those people who have taken the shares of the company will also feel risky. As the company might not go into bankruptcy. The company is issuing more and more debt. The company is paying interest rate on that. The company's debt structure is rising. Even the equity, cost of equity will also start to rise. So that is the thing we need to understand because when your debt rises, not only the cost of debt, but also the cost of equity also rises. By the debt structure, the equity shareholders are also impacted. And one thing we need to take into consideration, whenever we are preparing the financial models, we tend to consider the cost of debt more than cost of equity. Is that always right? Is that always right? Because every time we are taking into consideration a higher cost of debt and lesser cost of equity. I believe equity shareholders, you know. They are taking the risk on their investments, correct? The market price might go down. Their investment might go to zero or negative. They might not get dividends, right? The second risk. The third risk is on account of the bondholders because the debt is rising. The fourth risk that we tend to ignore, is what? Equity shareholders are always paid after the debt holders. If the company goes into liquidation, if the company goes into bankruptcy, the assets of the company would be sold off, and the first preference would be given to debt holders, then the preference shareholders, and then the equity shareholders. They are bearing four kinds of risk, but the debt holders are just bearing just one kind of risk. Just the company's debt is rising, and as a result, their cost of debt is rising. But the equity shareholders are facing risk upon their value of investment if it goes down, if they might not get dividends, right? Number three, on the basis of the debt, if the company is increasing the debt, the bankruptcy cost. And the fourth one, they are the residual owners. If something is left, then only the equity shareholders will be paid off. Do you really believe the cost of equity should be less than cost of debt while preparing the financial modeling? Every person in the market is being using a higher cost of debt and lesser cost of equity. Okay, let's try to understand this scenario from a different mindset also. Cost of equity ideally should be higher than cost of debt. There can be scenarios in which cost of equity might be lesser than cost of debt. But all these 4 points, like which I told you, stresses us to think whether or if the cost of equity we can take higher than the cost of debt. Okay, so these things we have to take into consideration. Any more queries, just tell me, because ultimately when you are taking into consideration both your cost of debt and cost of equity, you tend to calculate your WACC, your weighted average cost of capital. We'll understand WACC like while preparing the financial model. Like we take into consideration the amount of debt into your cost of debt, your amount of equity into cost of equity. We'll calculate these. We'll learn how to calculate cost of debt, cost of equity, and WACC. But as for now, WACC is your weighted average cost of capital. Weighted average cost of capital, which takes into consideration both the cost of debt and cost of equity. Okay, that is something we need to understand. Any queries in the chat box? Like, let me know because we are almost at the end of the session. Bhushan asked me, will higher WACC affect the valuations? Obviously, if the firm is having a higher weighted average cost of capital, the valuation of the company can come down. This will understand in the financial modeling sessions. Your WACC is also called your overall cost of capital. Overall cost of capital or weighted average cost of capital. It is also called just the cost of capital. See, like whenever you are talking about cost of debt, it is your debt related cost, cost of equity, or equity related cost. But if someone says you just the cost of capital, it takes into consideration both the cost of debt and cost of equity. It is same as back the weighted average cost of capital or the overall cost of equity. Okay, that will understand. Any more queries? Let me know. Yes, apart from debt to equity ratio, Umesh, you have to also see the cash flow, CFO ratios. You have to take into consideration the liquidity ratios, profitability ratios, the return ratios. All these ratios we'll talk about. So don't worry. Any more questions? So debt to equity is clear to us from a different perspective today. Okay, I'll just wait for a minute or so. Ask me any questions. Ask me on WhatsApp. Ask me on LinkedIn. Ask me on the websites or any other social media platforms. Any of the questions you have, me and my team will be happy to clear that. Okay. Any more questions? Let me know. If not, then we can end the session for today. And the next session we'll try to talk about the interest coverage ratios, debt to income ratios, fixed charge ratios, debt service coverage ratios, right? Debt to EBITDA ratios. All these ratios, like we'll try to understand in the subsequent sessions. Okay. So good luck, guys. Thank you so much. Feel free to ask for queries on any of the platforms. Thank you.